Now here's the great part of this type of technical analysis. The templates that you're going to see me post throughout this course are ones that you can very often overlay onto different charts. So you'll see this pattern, for instance, repeated on a 1-minute chart or even on a weekly chart. And they will look exactly like this or with very minute variations. Here's a chart of AXA, for instance, which gives you a great example of this type of adjusted stop method, but as it applies to a swing trade setup. Now, a typical stop on AXA would have been under the 33.47 low from April. Notice that although AXA broke out very quickly initially, it also pulled back just as quickly. As it came back down into this prior support level, it began to form a congestion along that low. Hence, the pace began to turn over. Adjusting the stop at this point to under 34.15 based upon the break of this more gradual range here basically results in a stop that was only about 40% less than it would have been otherwise. So you're taking a stop that is a 60% stop loss as opposed to 100% stop loss. And while this method can increase the chances of a false stop very slightly, the savings will more than make up for it. I find that maybe my chances of this original stop not getting hit, but at the same point this adjusted stop does get hit, is only about a 5% or less difference. However, if you're saving 40% or 50% of your stop loss each time you do this, it more than makes up for it.